Hi everyone, thanks for joining us today.
It does sound sophisticated.
Sophisticated, yeah.
The ACE community for 3 years now.
Actually outlined everything.
Something that we find in the society.
First, talk about the problems that you're trying to solve.
I'm going to ask each of them to quickly tell us what their organization does and what it focuses on.
I guess deep tech investment is obviously one of the verticals that we cover, but I would add the fact that Green Sky is a generalist fund in Canada. Our focus geographically is earlier stage Canadian companies, and that just means that limiting ourselves to only the deep tech vertical is not very easy. But the only limitation that we have put on our investment is just to be B2B and be Canadian. So we have investments in enterprise SaaS as well, but obviously investing in companies that have differentiated technologies is our passion, and that's where we think that we should focus on. Other organizations that I work with also have the passion of investing in IP-focused companies. So IP and specifically IP generated in Canada and commercializing that is definitely a passion of mine.
Yeah, so I'm really focused on extremely early stage, and there's a reason for that. That stems from my background when I worked for a VC firm quite a while back and ended up getting parachuted into a couple of the companies that were spin-offs from the universities. And that's still very much what I like to do. Some of the companies are already formed, already running. Some may be pre-revenue, some may be revenue, but there are several examples of companies that I've been also a catalyst for the formation of the company while it's still within academia. And it's a really interesting area. What I like to do is I like to try and add, as well as capital that I think I mentioned before could range anywhere from 10,000 to 75,000. What I like to do is add some of the business and especially to really good technical teams, and that stems from some of the work that I've done in the past.
So for Matter Ventures, we started this fund a couple of years ago. And it seemed to be following a lot of, I'd say, diversity funds on the cusp of what happened in the States with George Floyd. And I guess our founder, Giselle Mello, decided that was, I guess, a cataclysmic moment for her to be able to do something like this in her life. She had planned on doing this for a while. But that moment was what kind of triggered what we're doing. And so we decided that we wanted to focus the fund at early stage and focus on underestimated founders. So it's Black, it's women, Indigenous, Latinx, people of color, people with disabilities, newcomers to the country, people who traditionally haven't had access to funding, and to be able to support them. For Altitude Accelerator, different game. And this is the reason why I'm here, is that this accelerator specifically focuses, as much as they support all founders, we support clean tech and sustainable companies. So anyone that wants to do anything, let's say within advanced manufacturing, solar, air, water, decarbonization, electrical vehicles, that's the stuff that we're supporting with subject matter expertise, our network, labs, funding, etc.
Okay, beautiful. So recently we have started a crowdfunding campaign on Aggregate Intellect where any community member or really any Canadian resident can invest in Aggregate Intellect and in return for equity. So one of the things that very quickly we realized that a lot of people are unfamiliar with private investing. So a lot of people have previously experienced investing in the stock market and public companies and all of those good things that you normally do through your bank or whatever, Wealthsimple or whatever tool you use. But investing in private companies is not something that a lot of people have experienced, but they are interested in it. So, I think all three of you have done this, earlier stage investments in companies that are private. So what are some of the differences in your mind, and some of the things that you didn't know at the beginning, but over time you learned? What are the nuances of this type of investment?
If you compare very early stage private investing to anything, the public markets or real estate or whatever asset class you happen to be looking at, the first thing is liquidity. You don't have that type of liquidity. You can't call, well, nobody calls a broker now, but you can't go online and decide, well, I'm going to buy X number of shares in a company, or I'm going to sell the next day. You're really in it for a period of time until there is some sort of liquidity event. So it's really not a short-term game. It's really something, number one, that you have to be prepared to wait until a number of really important aspects begin to happen. One, the team really has to prove themselves out, and they have to stick with it. So you have a natural attrition sometimes of companies that just don't make it because it's a tough slog, and people give up. You've got great ideas out there that sometimes don't, for any number of reasons, work. They don't make it to the market, and they don't generate sufficient revenue to be able to become a sustainable business. So there's a lot of risk involved. I mean, that's the big thing. But on the other hand, I think that at early stage, especially when we're talking about things like the new crowdfunding platforms, things like AngelList came out, it's at least about 10 years ago, that have allowed people to come in with smaller amounts of money. I think the biggest thing is that it allows people to invest in something that really interests them, that really turns them on, that maybe it's a personal connection to the founders, maybe it's a personal connection to what the founders are doing. But I think that that's one really important aspect of it. If you really believe in what the team is doing, it allows you to really be part of that journey.
To sort of regurgitate what you said, is that it's a risky affair, and the timelines are long, but most people who engage in private investing do that because they want to support a movement, support a specific person who is doing something that is interesting to you as an investor, or that's a change you want to see in the world, and if you do it right, you can support that movement to happen. So maybe Hessie, like quickly, from your point of view, so Darryl emphasized that it should be a cause that you care about. It should be people that you can put your trust in, that they don't give up, and they actually have the likelihood of success. So what's the de-risking process? Because obviously there are investments, deals that are more risky and ones that are less risky. So what's the process of figuring that out for you?
I don't invest in people I don't know. So sometimes it takes a little bit longer for investors to get to know companies. And so I always encourage companies, even if you're not ready, come to me. And if it's something, first of all, that I know something about, because like don't come to me like 2 years ago. I know nothing about sustainable technologies, about alternative materials, that kind of thing. I will not be able to either add value or even determine whether or not you're actually faking it. You know what I mean? If I know enough about the topic and I can help you, then please come to me, and then we can have a discussion and create that relationship over time, so that you not only get to know the individual, build a relationship, but also help them along the way as they're looking for investment. So that from a de-risking perspective, it's really about building that relationship. And also I think like over time, and this is something that it's kind of counterintuitive to what we're doing today, because most VCs find deals through their network. And that's the biggest issue that I have, or many diversity funds that are just emerging funds have, because first of all, they don't have the network, and they're trying to give founders who've never had access the network to investment. So typically the trust is found between the trust is built between two VCs who've been on the same cap table for many years, and so they give each other deals, and usually it helps one to not have to do the due diligence that lead investor did, because hey, I've done deals with him many times in the past. I would say that needs to change. And, as much as we're trying to de-risk that side of it, we have to be able to open up our networks at the same time and look outside for other types of deals that may not traditionally have gone into our network. And that's a longer process, but that also takes time to build those relationships to be able to de-risk that investment over the long haul.
Okay, very interesting. So again, to regurgitate what you said and try to summarize it. So relationship is very important. So this is like a marriage. You have to go through the whole process of courting and dating and then getting into a relationship. So that makes a lot of sense. And definitely, relationships that it starts through friends of friends in your network, professional friends of friends, have higher likelihood of success because of the social capital that comes with it. And I think one of the very, very important things that you said, and I have experienced quite a bit as well myself, is that a lot of the time investors are not only interested to just put in money and be completely hands off. Like as we said, as part of that Darryl said, a lot of the time the purpose is, they want to see some change in the world. So in addition to capital, they want to see, okay, how can I help these founders actually succeed? And Moien, you and I talked about this quite a bit. We are co-hosts on a YouTube show about startup fundraising, and your motivation to move from, the entrepreneurship side to the investment side was actually to help technical founders communicate better. So talk to us about that. What's that thought process when you're considering an earlier stage investment? What are you thinking about in terms of how can I help these founders in addition to, capital?
So we would love to invest on the founder rather than the technology, just because we've realized over time that an amazing founder and a mediocre technology would lead to amazing results, but a mediocre founder and an amazing technology and idea was probably not lead to anything. So if you have lucked down a person who's a founder, is like a hustler, is amazing, you can match up with them, you understand each other, you can help them, they're coachable, etc., and a laundry list of other items and characteristics, that gives the investor a lot of comfort into even if this technology doesn't get anywhere, this person can just turn everything around and make this happen. Historically, what I've realized is that when very technical founders come to VCs, it is often challenging for them to communicate what the technology is. It is often challenging for them that this is not a solution looking for a problem, but it's actually there is a problem. You've come up with a solution. The solution has been formed after many years of research, plus with and etc. So that now I'm looking for capital, but I'm also looking for any other sort of support. My thought process was that at least Canadian investment ecosystem needs more support and needs someone or like a group of folks that can translate what the tech founders are talking about and be able to and give that comfort to all the investors that, okay, this is actually the technology that is going to solve this problem. And that's kind of the segue to where the deep tech comes from. There's a lot of IP, there's a lot of research done. The founders are very technical. They have spent a lot of years in the school. Now they want to commercialize it.
What you're saying resonates quite a bit. Darryl has been working with us as an advisor for a while, and he's also one of our investors. And one of the things that I really enjoy working with him is, all of the things that goes beyond capital, like strategizing, trying to communicate ideas, trying to prioritize parts that are more important. We are currently part of Creative Destruction Lab new cohort, and in the socials, I was talking to all of these, very, very deep tech founders who are complaining that, obviously if I do X and Y and Z, which is like super technical thing, of course, that's going to change the world, etc. But they were complaining that the investors they were talking to were all complaining that, oh, who are you going to sell to, right? And from a founder's point of view, you know, the fundamental idea is that if I do this thing, it will completely change everything, and we'll have so many use cases. So why are you asking me to focus on one use case and try to sell to one person? But you know, that complete fundamental point of view, change in point of view that needs to happen from, you know, building a business, you know, de-risking a business by selling, you know, this pen first and then building the spaceship you're trying to build, is very interesting. And through mentors like yourselves who have gone through some of this path in the past, is definitely very helpful. So I had written down a question to ask, and you know, Moien, you said that founders should be coachable. You know, Darryl, you said, or I don't know, maybe Hessie said that, you know, they have to have tenacity and grit, and you know, be able to adapt and change and move forward. But I'm going to ask the opposite of that. What's the most important red flags in founders for you that immediately makes them, you know, not a particularly good opportunity for investment?
One thing I'm starting to see is, especially during this downturn, is whether or not a founder has resilience. Sometimes I think what happens when they start seeing that their valuation goes down, or they see investors backing away, it is that, you know, suddenly they have a lack of focus, and they don't know where the money's going to come from. So what do I do next? So they have to show, you know, what am I going to do with the few resources that I have, not knowing how long this is going to last, and and how can I keep my company alive? So I think for the most part, the resilience is going to be really important. They have to realize that they can't time markets. The market is what it is. So they have to kind of dig deep and do what they can to reduce their burn rate, but grow their business responsibly, right, while they're waiting for capital. And I think that that's something that that I look at, especially now, like when times are tough, what's happening with the founder.
I think if you take it back a little bit earlier, when somebody has actually made the commitment, you know, a founder, an entrepreneur has made the commitment to actually do something, what I like to see, you know, if you talk about red flags, is that people have to be doing this for the right reason. It's not about going out there and making a lot of money, because they're not going to complete the whole process if it's just about the money. There's just too many obstacles and too many problems. One of the other things is I'd like to know that somebody is all in. And I completely understand people have bills to pay and they start off doing it part-time, but there comes a time when you have to ask the question, you know, when are you going to be doing this full-time? When are you going to be all in? And that's a very, very important piece, because part-time entrepreneurs are not going to be successful entrepreneurs. It's really, you're focused 100% on what you're doing and you're passionate about it. And it's something that you're doing for a lot of other reasons besides trying to make a lot of money. You know, those are really the red flags. It's you know, there has to be a level of commitment, and there has to be a vision, there has to be a passion, there has to be something that someone is trying to do, aside from trying to go out there and making as much money as they can.
100%. One of the things that I like to say to a lot of people that I talk to, you know, I have this career coaching thing that I do 20 minutes every day with anybody who wants to ask me about data science, about startups, etc. You know, sometimes people book me and say, I have this idea, I don't know where to start. And a lot of the time, that's one of the things that I say, that this is, for me, every quarter is 100x harder than what I thought it would be in the past quarter. So it's a very, very tough game, and it never gets easy even when you raise money. I haven't raised a significant amount of money yet, but I've heard from other founders that even when you raise money, it just becomes harder. Like it never becomes easier because the complexity of the problem statement changes. So definitely working on something that is very, very close and personal is very, very important.
Top of the list for me is humility and coachability. And that's just like because personal experience. Again, I bring back what I said. An amazing founder, mediocre technology versus a mediocre founder, amazing technology. And what makes a founder amazing is coachability and humility. The fact that you agree that so no one knows what is happening in that specific venture space. You might technologically be familiar with the vertical that you're operating in. You might know the business because you have work experience in that vertical. But starting a business with the idea of I know everything that is happening in this vertical is actually a killer for that business. The same goes with the VCs and investors. Nobody knows, to be honest, nobody knows what is happening. We are all just speculating. If you knew what future holds, we wouldn't be having these kind of conversations. So nobody knows what is happening. We are all collectively trying to support each other and trying to come up with the right strategy to move forward. But if the founder isn't coachable or doesn't have humility, that makes it just impossible to work with them. I might have an opinion about something which might be completely wrong, but I want to make sure that when I'm talking to my founder, I'd openly say, this is what I think. What do you think about it? Have some exchange there, learn something about the process, come up with the right strategy, and then move forward. This is obviously the right hypothesis that we want to start working on. It might be wrong again, but the fact that we can work together and exchange idea is just something that makes it worthwhile.
100%. And I think, that relates very closely to what Hessie said earlier about building relationships. It shouldn't be a transactional deal that you do and then you go your separate path. A lot of the time, especially in earlier stages, it's all about being able to interact with each other and learn from each other's experiences. So in our community, even, we have created this little group of, inner circle of the community that you're meeting every week, every couple of weeks. And we ask them, what should we do differently? They're not, not all of them are investing their money. Some of them are in our company, but a lot of the time we are, they're investing their time in our community. They're hanging out in our community, providing feedback about everything we are doing. And they're telling us what they want. And, people coming from all different points of view, providing, what they think a product should be. And then you as a founder, compiling all of this information and being open and having growth mindset is extremely important. I would like to ask each of you, I opened this session by saying, people in our community who want to invest in our company through the crowdfunding, but, a lot of them, this is the very, very first time they're investing in a private company. We talked about what you're looking for, et cetera, but, thinking about the very, very first time you did this, each of you, the very, very first time you invested in a startup, what advice do you have? What should they look at? What should they pay attention to?
Probably compared to Moien and Darryl, I'm probably the least investment savvy. I came into venture capital as someone who's worked in startup for 10, 15 years. So all the jargon, all the VC lingo, I had to learn. I had no idea that startups were actually called deal flow. And I'm going, well, that's kind of rude. But at the same time, I started to realize exactly how a VC's mind thinks. When you're very early stage, you can do things like SAFEs, which are simple agreements for future equity. That is also an option for companies who are so early that they don't have valuation. And so think of those levers.
So for the people that are listening in that are looking at investing, because I can certainly remember the first couple of companies that I invested in, and it can be a little bit nerve-wracking, but I think you really have to go to the basics. Do you know the people behind the company? Do you trust them? Do you believe that what they're doing has a real market? Is there a need out there? They're really, really basic questions. And if you really can check off that list and say, yeah, I really believe that these people behind the company know what they're doing. At least they know the area. There's going to be all sorts of things that happen along the way. What originally started off may not be where the company is focused in 6 months or in a year. That may change several times. But again, I think we've all mentioned it. You're really at this stage betting on the people more than what the company or the idea is actually about. The idea obviously helps a lot. And I think that you can use the same sort of criteria that you use in anything else. Invest in what you know. If you are somebody who comes from the world of AI and you know that something is really applicable and it has a market, and even say to yourself, yeah, this is something that I would do. If I were going to do something, this might be an interesting business to be in, then it's certainly worth taking a risk. And the amount of capital that you can put in is really the amount of capital that you can afford to lose, because it's a high risk situation. Nobody knows what's going to happen.
So I'm going to start with risk and diversification. So whatever you want to put in the venture business should be a small portion of all of your assets, and you should be very comfortable with losing all of it. That's the first rule. Second would be, if you're comfortable with doing your due diligence, the same metrics that Darryl was mentioning, that's great. So you know the space, you know the founder, you believe in the space and founder and the impact. Obviously, that gives you a lot of comfort to move forward.
And I think a lot of people here, hopefully, are more familiar with investment in the public markets through stock markets and such. And investing in a startup, especially through a crowdfunding like ours, which is, with a minimum of $500 you can participate, is a good way of diversifying, your investment. So thank you so much, Hessie, Moien, and Darryl, for providing your insight.